You work hard. You earn money. But somehow you still feel behind. You watch the markets move. You hear words like inflation, recession, interest rates, debt ceiling. And deep down you know something uncomfortable. You don't fully understand the system that controls your future. That's not your fault. No one taught you how money really works. Not emotionally, not historically, not psychologically. Here's the truth most people ignore. Money is not just currency. It's power over time. It's trust between strangers. It's a weapon. It's a mirror. And if you don't understand it, you will be used by it. In this video, we're breaking down The Ascent of Money by Niall Ferguson, not as a boring history lesson, but as a psychological map of how finance shaped empires, crashed economies, and quietly shapes your daily life. You'll learn why debt built civilizations and destroyed them, how stock markets manipulate human emotion, why housing feels safe but hides leverage, how financial crises follow predictable patterns, and most importantly, how to think clearly in a system designed to exploit impatience. This isn't about getting rich quick. It's about understanding the game you're already playing. Because once you see the structure, you stop reacting, and you start moving with awareness. Let's begin. Chapter 1. You think money is about wealth? It's about power. Have you ever asked yourself why money rules your emotions? Why a number on a screen can change your posture, your sleep, your sense of worth? You say you want wealth, but what you really want is control. Niall Ferguson wrote The Ascent of Money not as a banker, but as a historian who saw a pattern. He studied empires, wars, revolutions. He noticed something uncomfortable. Behind every sword, there was a bond. Behind every king, a creditor. Behind every collapse, a financial system cracking in silence. He wrote this book after the 2008 financial crisis shook the modern world. Banks failed. Trust evaporated. People realized they did not understand the machine that governed their lives. Ferguson saw the ignorance. And ignorance, when tied to money, is dangerous. He wanted to tell a story, not of coins, not of numbers, but of human ambition. Money, he argues, is not metal or paper. It is trust organized. It is belief structured. It is a contract between strangers who will never meet. This might sound simple. It is not, because trust can be built, and trust can be manipulated. History shows this clearly. When societies learned to lend and borrow, they unlocked growth. When they abused debt, they invited collapse. Even the Renaissance rose on credit networks, and even global crises were fueled by leverage dressed as innovation. Machiavelli said power rests on perception. Ferguson shows that finance is perception institutionalized. Here's the deeper layer. Money mirrors human psychology. We discount the future. Behavioral economist George Ainsley found in 1975 that people prefer smaller immediate rewards over larger future ones. That weakness, impatience, built entire credit systems. Banks profit from your short-term bias. Governments exploit it through debt. This is not evil by default, but it is dangerous when unconscious. Debt can build bridges, and it can build prisons. Ferguson wrote this book to pull the curtain back, to show that financial systems evolve like organisms, from simple barter to complex derivatives. Each stage reflects human creativity and human greed. And here's the uncomfortable truth. You participate in this system every day. Your savings account, your mortgage, your retirement fund. You are not outside of it. So ask yourself, do you understand the force that shapes your future? Or are you just reacting to it? Money is not about wealth. It is about power over time. And if you don't understand time, someone else will price it for you. This is where our story begins. Chapter 2. You trust paper more than people. Why? Let me ask you something uncomfortable. If tomorrow the dollar became just paper, would you still believe in it? You say yes without thinking. That's the point. Ferguson begins the real journey here, not with Wall Street, but with the birth of credit. The shift from metal to promise, from gold in hand to ink on paper. He shows how early bankers in Renaissance Italy discovered something radical. You don't need gold to create wealth. You need trust recorded. Double-entry bookkeeping, invented in the 15th century, turned chaos into structure. It allowed merchants to see profit, loss, risk clearly. That clarity built empires. But here's what you miss. Credit is belief in the future, and the future is uncertain. When the Medici Bank rose, it did not rise on coins. It rose on reputation. When it fell because trust cracked, not because gold disappeared. You live in the same structure, just digitized. Psychologist Daniel Kahneman showed in 1979 that humans fear loss more than they value gain. Loss aversion. That bias shapes markets. It shapes bank runs. When fear spreads, logic dissolves. You don't withdraw money because you need it. You withdraw because others are withdrawing. Contagion is psychological before it is financial. Sun Tzu said the supreme art of war is to subdue the enemy without fighting. Finance mastered this long ago. Confidence moves markets more than armies. This might sound cold, but understand this clearly. Banks are not vaults. They are bridges between present desire and future income. They lend long, borrow short. That mismatch is fragile by design. When too many demand their money at once, the system trembles. That is not conspiracy. That is structure. Ferguson writes this to show you something deeper. Civilization advanced not because of gold mines, but because of credit networks. Bonds funded governments. Loans funded voyages. Risk became shareable. Even modern stock markets are just public trust exchanges. So ask yourself, what do you really own? Your house? Or the mortgage contract? Your cash? Or the belief others accept it? Marcus Aurelius urged control over what is within you. Trust, however, lives between us. And that space, between you and others, is where money truly exists. You don't hold wealth. You hold promises. And promises are only as strong as the character and discipline behind them. Chapter 3. You fear debt, but you worship it every day. Be honest. When you hear the word debt, do you feel tension in your chest? Good. You should. But here's the twist. The modern world runs on debt, and you participate in it daily. Ferguson moves the story forward here, into the age of bonds. Not dramatic, not loud, just contracts. Sold quietly to fund wars, revolutions, governments. This is where money stops being personal and becomes political. In the 17th and 18th centuries, states discovered something powerful. They could borrow from their own citizens, not from kings, not from conquerors, from investors. Government bonds were born. Britain mastered this. It built credibility, paid interest on time, managed its debt with discipline. As a result, it financed wars more efficiently than rivals. Naval dominance was not just about ships. It was about creditworthiness. Debt became strategy. Nietzsche spoke of promises as measures of strength. A society that keeps promises grows powerful. A society that defaults decays. But don't romanticize this. Debt can enslave nations just as easily as it empowers them. When borrowing exceeds production, when interest compounds faster than growth, the structure strains. This is mathematics, not morality. Irving Fisher in 1933 described debt deflation. When falling prices increased the real burden of debt. That spiral crushed economies during the Great Depression. People tried to save more, but collectively made things worse. This is the paradox of thrift. You see the pattern? Individual logic, collective chaos. You pay interest on a credit card, thinking short-term. Governments issue bonds, thinking long-term. Both rely on the same psychological fuel, optimism about tomorrow. But optimism without discipline becomes illusion. Seneca warned that borrowing troubles from the future is a foolish habit. Modern finance industrialized that habit. Still, Ferguson does not condemn debt outright. He shows its dual nature. Bonds allowed constitutional governments to rise. They limited rulers because rulers now depended on market trust. Power shifted from throne to creditor. That shift shaped democracy. So when you hear national debt, ask a sharper question. Who owns it? Who trusts it? And who benefits from its interest stream? Debt is not inherently evil. It is leverage over time. Used wisely, it builds civilizations. Used recklessly, it erodes them from within. And you, whether you admit it or not, live inside that tension. Chapter 4. You chase stocks, but do you understand the game? Tell me something. When you buy a stock, what are you really buying? Ownership or hope? Ferguson takes us into the birth of the stock market, not as a casino, but as a psychological theater. The Dutch East India Company in the 1600s issued shares to fund global trade. It was brilliant. Risk was divided. Profit was shared. A new structure was born. Limited liability. That simple idea changed everything. You could invest without risking your entire life. You could participate in empire without sailing a ship. Sounds empowering. It was, but it also unlocked speculation. When shares began trading freely in Amsterdam, people discovered something dangerous. Price could detach from value. Expectations, not earnings, began driving behavior. Sound familiar? Charles Mackay wrote about crowd madness in 1841. Tulip mania, bubbles, collective delusion. He wasn't mocking investors. He was exposing human vulnerability. Because here's the truth. Markets amplify emotion. Robert Shiller showed in 2000 that irrational exuberance fuels asset bubbles. Stories spread faster than data. You don't buy because numbers make sense. You buy because others are buying. Herd instinct. Ancient. Primal. Hard to resist. This might sound harsh, but most people don't invest. They react. They chase momentum. They fear missing out. They confuse volatility with opportunity. Speculation is not the same as investment. Ferguson shows how stock markets financed railways, industries, innovation. They created wealth on a scale never seen before. But they also generated crashes. 1720, 1929, 2000, 2008. The pattern repeats. Optimism, leverage, euphoria, collapse. Sun Tzu advised knowing both yourself and your enemy. In markets, your enemy is often your own impulse. You think you're rational, but behavioral finance says otherwise. Overconfidence bias, studied by Barber and Odin in 2001, found that frequent traders underperform because they believe too strongly in their judgment. The market does not reward ego. It rewards discipline. So when you open a trading app, pause. Are you buying a business or a narrative? Are you building wealth or feeding adrenaline? The stock market is a tool, powerful, neutral, but in weak hands, it becomes a mirror reflecting impatience, greed, fear. Ferguson doesn't condemn markets. He respects them, but he reminds you, markets are human systems, and humans are flawed. If you don't master yourself, the market will teach you humility, expensively. Chapter 5. You want safety, so why do you gamble with it? Let me ask you something quiet. When you buy insurance, what are you really purchasing? Peace or fear management? Ferguson shifts the lens here, from markets and bonds to risk itself. The birth of insurance was not glamorous. It began with ships crossing dangerous seas. Merchants asked a simple question. What if we could share loss the same way we share profit? So they priced uncertainty. In coffee houses in London, underwriters gathered. They studied storms, routes, cargo. They calculated probability before probability had a formal name. Over time, actuarial science emerged. Discipline over chaos. Insurance became civilization's shield. But here's the deeper layer. Risk never disappears. It moves. You transfer it to an institution. The institution pools it. The system absorbs it until it doesn't. This might sound uncomfortable. When risk is mispriced, the illusion of safety becomes the greatest danger. Look at 2008. Mortgage-backed securities were sold as stable. Ratings said safe. Models said unlikely to fail. But those models assumed housing prices would not fall nationwide. That assumption was wrong. Psychologist Philip Tetlock found in 2005 that experts are often overconfident in complex predictions. The more complicated the system, the more fragile it becomes under false certainty. Insurance works when uncertainty is measurable. It breaks when uncertainty is disguised. Ferguson shows how life insurance changed families, how pensions shaped retirement, how derivatives evolved as modern risk tools. Used wisely, they smooth volatility. Used recklessly, they amplify it. Marcus Aurelius reminded himself daily of impermanence. Insurance tries to quantify impermanence. But here's the question for you. Do you seek security, or do you outsource responsibility? There is a difference. True security is discipline, savings, margin for error. Financial products are supplements, not substitutes. Seneca warned that fate governs half of life. The other half is ours. Insurance manages fate's half. Your habits govern the rest. So examine your behavior. Are you building resilience, or just buying protection? Because when systems fail, contracts are tested. And in moments of stress, what you thought was guaranteed may reveal its limits. Risk cannot be erased. It can only be understood, priced, and respected. Ignore that truth, and safety becomes another gamble. The video is half finished. If you like the video, be sure to comment and watch the next steps. Chapter 6. You call it real estate, but it's leverage in disguise. Let's go straight to it. When you say, I own a home, do you actually own it? Or does the bank own most of it? And you own the obligation? Ferguson moves into property, into land, into the dream sold as stability. Real estate feels solid. You can touch it, walk on it, live inside it. That physical presence tricks your mind into believing it is safe. But property markets are financial systems wearing brick and wood. Mortgages made ownership accessible. That was revolutionary. Instead of saving for decades, you borrow against your future income. You compress time. You live now, pay later. Leverage. It builds wealth when prices rise. It destroys balance when they fall. This might sound blunt, but it needs to be said. Leverage magnifies both intelligence and stupidity. In the early 2000s, banks extended credit to borrowers with weak income verification. Subprime lending expanded. Loans were bundled, sliced, sold globally. Risk was dispersed so widely that people assumed it vanished. It didn't vanish. It accumulated. Economist Hyman Minsky argued that stability breeds instability. Long periods of calm encourage risk-taking. People move from safe financing to speculative financing, then to what he called Ponzi finance, where repayment depends on rising asset prices. Sound familiar? Housing stopped being shelter. It became speculation. Psychology played its part. Case and Schiller found in 2003 that homebuyers often expect prices to keep rising simply because they have risen. Extrapolation bias. We project the recent past into the infinite future. But cycles do not care about your optimism. When housing prices fell in 2008, foreclosures surged. Families lost homes. Banks collapsed. The same system that promised stability revealed fragility. Ferguson doesn't mock homeownership. He warns against blind belief. Property is not just shelter. It is debt secured by land. Seneca advised preparing for loss before it happens. Not to live in fear, but to live grounded. So ask yourself, if prices fell tomorrow, could you endure it? Or would leverage expose you? Real estate can be a pillar of wealth, but only when built on margin, not illusion. Brick feels permanent. Debt never forgets, and gravity, in markets, always returns. Chapter 7. You trust the system, but do you understand its fragility? Let me ask you something you avoid. What holds the global financial system together? Is it laws? Is it regulators? Or is it something softer, And more fragile? Ferguson now widens the frame. We leave individual assets behind and enter the architecture of global finance. Central banks, international institutions, interconnected balance sheets stretching across continents. It looks stable. It feels permanent. It is not. Modern finance is built on interdependence. Banks lend to banks. Countries hold each other's debt. Currencies float. Capital moves at light speed. One failure can echo globally. In 1914, global markets were deeply integrated. Then war fractured trust overnight. In 2008, Lehman Brothers collapsed. And within days, credit markets froze worldwide. The lesson is not that integration is bad. The lesson is that complexity without transparency breeds vulnerability. Psychologist Nassim Nicholas Taleb argued that systems exposed to rare, extreme shock suffer from what he called black swan events. Low probability, massive impact. We underestimate them because our brains crave patterns, not randomness. So we build models. We create safeguards. We assume control. But control in complex systems is often an illusion. Central banks step in during crises. They lower interest rates, inject liquidity, expand balance sheets. This stabilizes panic. But it also reshapes incentives. Cheap money encourages risk. Prolonged intervention distorts price signals. Over time, markets adapt to rescue. Moral hazard emerges. When actors believe they will be saved, they take greater risks. Not because they are evil, but because incentives guide behavior. Zeno, founder of Stoicism, emphasized living according to nature, accepting limits. Modern finance often resists limits. It stretches credit. It engineers complexity. It assumes tomorrow will cooperate. Sometimes it does. Sometimes it doesn't. Ferguson's deeper point is subtle. Financial globalization increases prosperity, but it also synchronizes fear. Panic spreads faster than ever. So here's the question for you. Do you confuse size with strength? Do you mistake speed for resilience? Strength is not expansion. Strength is endurance. And endurance requires humility in the face of uncertainty. The system works until trust fractures. And trust, as you've seen before, is the invisible foundation. Crack that, and even giants fall. Chapter 8. You blame capitalism, but do you understand its engine? Let me press you a little. When you say, capitalism is broken, what exactly do you mean? Are you angry at inequality? At bankers? At corporations? Or are you reacting to something deeper? Something you haven't named? Ferguson now steps back from individual crises and asks a larger question. Why did the West rise economically? Why did some nations industrialize, innovate, compound wealth, while others stagnated? His answer is not mystical. It is institutional. Secure property rights, reliable courts, financial markets that connect savings to investment, and political systems that restrain arbitrary power. Capitalism at its core is not greed. It is coordination through prices. But here's the tension. Capitalism rewards those who control capital faster than those who sell labor. That gap compounds. Thomas Piketty argued in 2014 that returns on capital often exceed economic growth, which can widen inequality over time. Whether you agree with his conclusions or not, the pattern forces a question. Who benefits most from financial expansion? You might feel the answer in your own life. Wages grow slowly. Assets grow faster. Resentment builds when opportunity feels closed. But pause. Capitalism is not a moral being. It has no conscience. It is a system of incentives. It amplifies productivity, innovation, risk-taking. It also amplifies disparity when rules favor incumbents. Psychologist Jonathan Haidt found in 2012 that moral judgments often arise from intuition first, reasoning second. We feel injustice before we articulate it. That emotional response fuels political movements. Yet Ferguson reminds us, markets flourished where law limited rulers. where contracts were enforced, where investors trusted that tomorrow's profits would not be confiscated. Machiavelli observed that stable republics require balance between elites and the people. Tilt too far, instability follows. So ask yourself, is your frustration aimed at the system's design or at its misuse? Capitalism is a tool, like fire, cooks food, and it burns cities. The difference lies in structure, discipline, governance. Blaming the engine is easy. Understanding its mechanics, harder, and mastering your place within it, harder still. Chapter 9. You think crises are accidents, but they follow patterns. Let me challenge you. When the next financial crash comes, will you call it unexpected? Or will you admit you saw the signs, but chose comfort over clarity? Ferguson brings us here to the anatomy of crisis, not as random disaster, but as recurring rhythm. History does not repeat perfectly, but it rhymes with precision. Credit expands, confidence rises, standards loosen, leverage builds quietly, then something small breaks, and suddenly, everything was obvious. Kindleberger mapped this cycle clearly. Displacement, boom, euphoria, distress, panic. The names change, the structure doesn't. South Sea Bubble, 1929. .com. Housing collapse, different assets, same psychology. This might sting. Crashes are rarely caused by one villain. They are collective self-deception. Psychologist Irving Janis described groupthink in 1972. Cohesive groups suppress dissent to preserve harmony. In finance, dissenters look foolish during booms. Caution feels outdated. Risk managers are sidelined until they're not. You've felt this dynamic in smaller ways. In conversations, in trends, in moments when everyone seems certain, and doubt feels socially expensive. Markets magnify that pressure. During expansion, debt looks manageable. Rising asset prices hide fragility. Minsky's warning returns here. Stability invites risk-taking. Risk-taking invites instability. But here's the deeper question. Why don't we learn? Because pain fades. Neuroscience shows that emotional memory weakens over time. The urgency of past suffering dulls. New generations enter markets without scar tissue. They inherit optimism, not caution, so cycles restart. Ferguson doesn't preach despair. He urges awareness. Crisis is not the enemy. Denial is. Seneca practiced negative visualization, imagining loss not to invite it, but to reduce shock when it comes. Financial discipline works the same way. Keep leverage modest. Question consensus. Respect volatility. You cannot stop cycles, but you can refuse to be surprised by them. When the next boom seduces you, remember this chapter. Patterns whisper before they scream. Will you listen, or will you join the chorus again? Chapter 10. You want wealth, but can you handle the responsibility? Let me end where it began. You don't just want money. You want freedom, security, status, control over your time. But here's the final question. If wealth amplifies who you already are you ready for that amplification? Ferguson closes the arc by reminding us that finance is not separate from human nature. It is its extension. From ancient credit systems to modern derivatives, the tools evolved. The impulses did not. Ambition, fear, impatience, hope. Money organizes these forces. It does not erase them. The modern world gives you access previous generations could not imagine. Brokerage apps, global markets, instant transfers. You can participate in the same system that once required aristocratic privilege. That is power. But power without self-mastery corrodes. Nietzsche wrote about becoming who you are. Finance accelerates that process. If you are disciplined, it compounds your strength. If you are reckless, it compounds your weakness. Wealth does not fix character flaws. It funds them. Research by Paul Piff in 2012 found that higher socioeconomic status can correlate with reduced empathy in certain contexts. Not always, but often enough to notice. Money can insulate you from consequence, and insulation breeds distortion. Yet wealth also enables generosity, creation, long-term thinking, can fund art, science, stability, can free you from survival anxiety. The outcome depends on the holder. Marcus Aurelius ruled an empire, yet reminded himself daily that power is temporary. That awareness preserved his clarity. So here is the distilled lesson. Understand money as history, respect it as psychology, use it as strategy, restrain it with discipline. Finance is not merely about markets, bonds, banks, or crises. It is about time. Your time. How you allocate it, how you trade it, how you protect it. The ascent of money is, in truth, the ascent of human complexity. And now the responsibility shifts to you. Will you be ruled by the system, or will you study it, master yourself, and move through it with awareness? Wealth is a tool. Character is the anchor. Choose carefully. Thank you very much for watching my video, and please like and subscribe to my channel.